Hello and welcome everybody. I'm Stephen and I'm a popular investor on eToro. Thank you very much for listening to this video, and as usual, please don't forget to take the time to this video and subscribe to my channel. That will be really awesome. So I want to thank you for your patience. I know I've been away from the channel now for at least a few weeks. I was actually on vacation for a short period of time and I was away from my video equipment, so I wasn't able to make a video. I tried to keep you updated as much as I could via eToro, via written message. But today I will be going back to my usual videos where I'll be talking about what happened in the markets, as well as talking a little bit about our portfolio performance and how our portfolio has fared and the overall strategy. So I'll get back into it, shall I? So last week, our portfolio was really pretty flat. Our portfolio was up just about 0.08% from the previous week. And the main reasons why it was up 0.08%, if we compare that with the other benchmarks, the Nasdaq was up about 2.5% and the S&P 500 was up about 0.3%. And the reason why our portfolio lagged slightly those main benchmarks was because in those benchmarks, it was stocks such as Nvidia, who had one of the greatest days of a single stock in the major indexes last week. And this caused a real kind of spike in those indices and also some of the major stocks in there. So if you didn't own those particular stocks, then it was quite likely that you were going to lag the overall indices. So if we compare that as well, the European market was also down last week. The FTSE 100 in particular was down about 1.67%. And also many of the European indices were also down. Bitcoin had a very good week last week. It was up about 4.21%. And I'll go into a little bit later in the crypto section about why Bitcoin outperformed last week. If we look on a 2023 year-to-date benchmark status, our portfolio is up about 15% overall for the year, which still is a very good performance. I understand that in kind of the last month or two, our portfolio has reduced slightly from its peak of what it was in kind of January and February of 2023 after that big surge that we had at the beginning of the year and the big recovery. I think that the markets now are starting to have effects of the high interest rates that are actually in play at the moment, and that battle really to bring down inflation. And this is causing some special hurdles when it comes to earnings, etc., for some of the large companies. So if we look at the Nasdaq, that's up about 24%. But as I said, the Nasdaq is heavily weighted on a lot of technology companies who suffered a lot last year. So some of the bounce backs of those stocks have caused the Nasdaq to spike. And if we compare that with the S&P 500, which is only up about 9.5%, and the Dow Jones, which is also up just a smaller amount as well, we will see that a lot of those outperformance is weighted towards some of the large tech companies which are in the Nasdaq. If we look at the FTSE 100, that's up only about 2.35% for the year. And the Hang Seng index, which is the Hong Kong index, is down about 6.04%. So it's been a very difficult time for China and the Chinese indices, especially considering what happened with the reopening up of the Chinese economy. There was a lot of optimism that this would bring bounce back in Hong Kong Chinese related stocks, but that bounce back has faded after the original optimism. However, I'm still very bullish on Hong Kong stocks moving forward, especially considering of the valuations that are in place for Hong Kong companies at the moment. And I still think that China is going to take a little bit of time for them to really come back online and start to thrive again after these COVID-19 lockdowns, which went on for a long period of time for multiple years. I expect that to take a little bit of time again to ramp up demand. Bitcoin's having a really great year, and it's up about 69.1%. So I also did some shorter term trades last week in our portfolio in order to really try to dampen some of the volatility in the market. So it allows me to be able to go both long and short. And I usually do this with a very small portion of our portfolio in shorter term trades. So I did some trades in Nvidia last week when Nvidia went up significantly in one day. I then placed a short-term short, or as it started to fade slightly towards the end of the session, and banked some profit. Also, I did a short-term trade in the Nasdaq, the Japan 225, which is the Japanese index, Nasdaq, Bank of Hawaii, which was a slightly it was short term, but it was maybe a couple of weeks. I managed to bank a strong profit of over 10% from that trade, as well as the VIX, and I did some trades in sugar and ASOS as well. So if we look at the main news from last week, the Nasdaq and the S&P 500, it's continued to produce strong results, and that is, as I mentioned, on the back of a few stocks performing pretty well last week. The wider stock market hasn't performed as well. If we look at a lot of the individual stocks outside of that technology area, we started to see some fading of performance in some of those stocks. As I mentioned, Nvidia recorded one of the largest market cap one-day gains in the history, and that was on the back of good earnings results and also optimism around AI. We also seen the debt ceiling agreement that has been agreed by both parties, which is good. As I mentioned many times, the debt ceiling is a topic that is always comes back into the public eye every year. And really, it's a jousting between the both political parties about what kind of concessions on spending, etc., that they can get. And it was always very likely that it was going to be agreed. It was just more about what terms of the agreement on lifting the debt ceiling would actually come into play. So that was agreed on Friday during the markets, and this helped cause a rally. So that's been a bit of a weight lifted off the market. We also saw some inflation data, which is the core inflation, which is not including food and energy. And this is often called the personal consumption expenditure, or the PCE. And we saw that rise by 0.4% in April, which was above expectations. But on a year-over-year basis, the index has risen to 4.7%. And this is really showing not much progress in terms of bringing down the inflation from the start of the year. So some really good news and some less favorable news. We've also seen in Europe, the German economy has officially entered into a recession in the first quarter, and that is according to the official figures. GDP has shrank by 0.3% in the 3 months, which goes through to March, and a downward revision from an early estimate of zero growth has reflected a sizable drop in household consumption. Although Germany has officially gone into a recession, we're still seeing the German indexes actually holding up pretty strongly. So it would be really interesting to keep an eye on data, not only in Europe, but especially in Germany over the next couple of months. We've also seen the European Central Bank policymakers such as Christine Lagarde, who's the president of the ECB, say that interest rates will need to continue to rise further and stay high in order to curb inflation in the medium term. There had been a lot of talks over the previous couple of months that they may be close to hitting the maximum level for the interest rates in this cycle. However, we're starting to see a lot of calls from the Bank of Spain and some other central banks around Europe, which are saying that the policy tightening has some way to go. And this kind of really sets up an overall message that we could see maybe at least another couple of very small rises before they halt interest rate rises in Europe. So I think Europe, as I mentioned, is a little bit further behind what's happened in the US because they were a lot slower to increase those interest rates. And I think there will be a lot later in terms of halting those rates. We've also seen inflation in the UK has started to slow in April to an annual rate of 8.7%, and that's from 10.1% in March, which is seen as a really good sign. But as you see, 8.7%, there's still 8.7%, there's still quite a long way to go. And the reason for that reduction, a lot of that is due to the previous surge in energy prices that occurred last year. We all know about the Russia-Ukraine conflict that caused energy prices to significantly spike. Well, they have started to come down, and we're starting to see that come into the inflation data in the UK. As I mentioned, China has been struggling recently in terms of the stock market and the general economy. And in China, we have started to see industrial output, retail sales, and fixed asset investments have all grown to a weaker than expected pace in April, while weak credit growth indicators have also pointed to sluggish domestic demand. As I mentioned earlier, there's a lot of optimism that coming out of these lockdowns and removing some of these stringent COVID-19 regulations would lead to a big bounce back in demand. That hasn't quite lived up to expectations. But as I said, I think it's just going to take a little bit of time. Things don't come on straight back into demand straight away. They've had several years of factories not operating at full capacity, people not being able to go out and buy as much as domestic demand as they would previously. So it just does take a little bit of time. We've also seen geopolitical risks have also dampened risk appetite in Beijing. So there was a news story last week that Chinese companies have been banned from buying Micron Technology products from China, and they are citing security risks after a review of Micron Technology's products. Again, there's been a lot of back and forth between China and the US on particular companies, whether that be Chinese companies with the US clamping down on them, or US companies and Chinese clamping down on them too. So it's a bit of tit for tat at the moment. And we also know that obviously there's a lot of conflict and a lot of tension at the moment around Taiwan-China relationship as well. So this kind of all feeds into that, and it all dampens sentiment around China. However, those valuations are extremely low at the moment, and if demand does continue to increase in China, which I expect it to, then I think that there's some really good gains to be made from Chinese stocks. If we look at the top 3 performing stocks for last week, and Micron Technologies was the top performing stock at about 8.45% last week. That was on the back of the NVIDIA earnings, and there was a general spike in tech stocks last week. The second best performing stock for last week is Magnite, and that was up about 3.33% for last week, and that is an advertising company. As well as the third best performing stock for last week, and that is Amazon. Amazon has had a really great year, albeit on the back of a really terrible year in 2022, and that continued to increase last week, and that was up about 3.32%. So as we move on to our Death by Charts editions, I just wanted to go over 4 charts in particular. And the chart to the left that I just wanted to go over was to show that NVIDIA saw its record jump in market cap last week in a single day. So just to put that into perspective, the market cap increased by 198 billion, and NVIDIA added more market cap in that one day where it spiked than the total market cap of 472 of the 500 companies in the S&P. So it just shows the true scale of that earnings report and the optimism around AI, which sent Nvidia to a record-breaking day in the market last week. And I think that brought a lot of technology stocks away with it. As I mentioned, we also saw that kind of core PCE number that came in inflation last week, and 4.7% over the estimate, which was 4.6%. And what that has caused is the next FOMC meeting is due on the 14th of June, and the futures are really now pricing in a high likelihood that they will increase those rates. So it's a 65% chance that they will increase the rates again by about 25 basis points and 0.25%. So that is the most likely level in order to try and bring inflation back to that 2% level. Excuse me. So the third chart that I wanted to go over is the chart and is the ratio between tech and energy. So this is the XLK and the XLE ETF. And this really just shows that over the last few years since COVID started, we did see a massive spike where technology companies were really outperforming the energy counterparts. We do know that energy went down significantly during COVID as the demand for oil and energy reduced, as there was a lot less activity. Tech stocks really benefited because of the influx of monetary printing and the monetary policy that was actually put in place and all the stimulus. So we saw that peak of that ratio in November 2020 when tech stocks were really surging. And then really in kind of 2022, we saw a complete reverse of that, where energy prices went up significantly because of the conflict between Ukraine and Russia, and then the demand for energy again after kind of COVID. And then we also saw those interest rates having to be increased significantly in order to quell inflation. And then we've seen tech stocks come down significantly and energy prices go up. We are starting to see a little bit of a bounce again this year in technology stocks, and energy has come down slightly. So that ratio is starting to increase slightly, but still very far away from all-time high levels. The chart to the right that I wanted to show you is there's this website called trueinflation.com, and what this really does is this measures inflation in real-time data. So the data that the Fed gets is often outdated, and there's often a big lagging effect on that. And really what we're seeing, if we measure up-to-date inflation data as per the website, we're seeing inflation at about 2.96% in real time. And that is against the US government reported rate of 4.9. So this can be a really good indicator of potentially what's to come once those lagging effects actually come to fruition and come into kind of real time. So we are expecting inflation to come down, mainly as the effect of those interest rates being increased and a drop in demand of consumer products and services as people have to tighten their belts and spend a lot less, especially considering people's mortgage rates have increased. So as we move on now to the crypto news and views, and first of all, I just wanted to say that Bitcoin had a very good week last week, and it's really still performing pretty in line with what happened in 2019. We're a very similar stage to what we are in the Bitcoin 4-year cycle. We're holding up pretty well at about just over 27,000. Towards the beginning of the week, we saw a dip in crypto markets. However, we hit that support level, and now we've seen a a good bounce back from Bitcoin kind of towards the end of last week and over the weekend. And I guess there's a couple of pieces of news that have showed a lot of positive developments. So one of them is around the stance that China has around Bitcoin and cryptocurrency in general. So in Hong Kong, they're allowing exchanges to be able to apply for licenses to be able to sell to retail and institutional investors. That is going to happen from the 1st of June. So I'm expecting an increase in volume to come out of Asia in that time. And it's really encouraging a lot of those Chinese entrepreneurs who previously had domiciled offshore to come back to Hong Kong or come back to China in order to set up these exchanges and be able to service Asian clients. So obviously Hong Kong is the test bed, but this is really showing that China is starting to relax their stance, and this could be really a test bed for mainland China adoption in the future. This is seen as a really positive in China, and I'll be very interested to see what the volume is over the next couple of months. Second thing that I just wanted to bring up was that we are seeing increased adoption of stable coins. And really what's happened over the last couple of months is we've seen a lot of the market cap, which was previously in USDC and through Circle, and also previously in BUSD, a lot of that has moved into Tether, as there was a lot of kind of tension between the SEC and USDC, as well as a few months ago, SEC also had some issues with Paxos, who's the issuer of BUSD as well. So we're seeing really all of that money flowing into the Tether stablecoin. Stablecoins kind of become more and more important in the crypto landscape. Last piece of news I just wanted to bring out as well was that Ripple has also taken a stake in an Asian exchange. Ripple had previously just concentrated on payments and working with kind of banks and governments all around the world. And they have made the first foray into exchange market and moved away just from previously doing payments as well. So this is seen as very positive in the market, and it will be very interesting to see how Ripple adapt here moving forward. And just to note that they have a very important legal case that's coming up, and it is expected that there will be a decision on that legal case about the US in the next couple of months. So the last chart that I just wanted to bring to your attention was the crypto trading volume. As I've been mentioning, there's not much US clarity around the regulations to do with crypto. It's been a actual part of the candidates for the US election, etc., who have been bringing up crypto recently, and all have different crypto stances. So that lack of US clarity is really affecting what's happening in the US around crypto. And what we're really seeing is a lot of that exchange volume that was previously in the US, a lot of it starting to move offshore. So we can see in 2020 that the offshore accounted for 90% of the trading volume and the US 10%. And now in 2023, the offshore's 86% and the US 14%. It is expected that that US number would increase quite significantly when there is some clarity around the regulations around crypto. However, that is not expected to be for a while. So we're still going to see a very concentrated amount of crypto being traded from offshore rather than the US. Okay, so that's my update for everybody. Thank you very much for everybody for staying patient with the portfolio. I know that after a really great start to 2023, things have started to curb off slightly, and that has been some more difficulty in the economy. But I really appreciate you having that long-term stance and sticking with me for the long term. And I'm really sure that for the rest of 2023 and beyond that we should produce good results. I'm very confident in our portfolio moving forward. So if you haven't joined my Discord group already, please make sure that you join that Discord group. We have an awesome community of people. We're regularly talking about what's happening in the markets, and we're very active in there. And you're also able to ask me any questions when you have them. Until then, thank you very much and have a great week ahead.